So the thumbnail was a bit clickbait. Um, I'm not done trading, but I am done with the strategies that I've been using since June of 2022. Right now it's January of 2023. So what I've been doing for about the last 6 or 7 months. So to jog your memory, I trade the portfolio that you see here on the screen. Um, if you want to see it in detail, you can hit pause. But in a nutshell, you have 11 sector ETFs. In sum, if you just hold the sector ETFs in equal proportions, it's probably more or less like an equal weighted S&P 500 index. I also trade 7 other ETFs, which you would call hedges. BITO, which is the Bitcoin ETF, DBC, which stands for Diversified Bucket of Commodities, EEM, which is Emerging Markets, FXI is China Large Cap, GLD is Gold, TLT is 20 plus years to maturity US Treasury bonds, and USO, which is crude oil. So I use leverage. This is a $31,000 portfolio, and if I'm into an individual stock, I'm in at $3,000. So if I'm into all 18 stocks at once, that's 18 times 3,000, or $54,000, or roughly two times leverage. So I'm rarely anywhere near 2x leverage. I think the highest I've been is about 1.5. For the past 4 months, I've been trading a real simple strategy, which is simply to buy a stock when it's above the 10-day moving average and then sell it when it's below the 10-day moving average. It's a very simple strategy, but does it work? Well, sort of. The black line shows when I started, early September of 2022. I started with $30,500 and I ended with $31,000. So kind of a, not terrible, but lackluster conclusion. But during that time, there's been a lot of up and down. If you look at where we bottomed out in October, I'm up over 10% from there. So this graph has 3 benchmarks. The orange one is just buy and hold the Dow Jones ETF, which is DIA. Red is buy and hold the SPY. Green is buy and hold on the diversified sector ETF portfolio that I showed earlier. So that's 11 sector ETFs plus 7 hedges. And then blue is my portfolio. So you can see that I'm really tracking buy and hold very tightly. It's kind of intriguing and instructive that I can be in and out of the market pretty frequently, putting in lots of work, and still I really don't beat buy or hold. I guess during the downturns you protect against the downside a little bit, but you lose that much to the upside. So that's certainly a lesson there. Buy and hold is hard to beat. So when you're comparing an active portfolio to buy and hold, it's easy to forget about the sources of friction. I use TD Ameritrade, which has no transaction fees, but I am using margin, and margin is actually quite expensive right now. The orange curve here is my portfolio if I had not paid margin fees. So you can see that over a few months' time, my active portfolio in blue is lagging by about 1% due to these margin costs. What this chart doesn't show is the dividends that I didn't earn by being out of the market when those ETFs paid out their dividends. It also doesn't account for taxes. While obviously I don't have huge capital gains this year, it's potentially probably about break even. All my capital gains are going to be in the active portfolio are going to be short term, whereas the buy and hold would be presumably long-term capital gains, unless you're rebalancing frequently. So this plot shows the daily price in blue, the 10-day moving average in red, and my cash position in orange. So when the cash is negative, it means I'm using margin. So in summary, you can see that I'm basically chasing the peaks and troughs of the market, lagging the price by probably 10 days. Now we didn't have the downturns. Usually lasted a couple months. Sometimes the stock market keeps going down almost without pause for many months. And in that case, it would be good to be mostly in cash, but there was kind of a roller coaster effect here. The peaks and troughs of my cash lagged the peaks and troughs of the market by about 10 days, which is not a surprise there. So in the market that we had in 2021, actually, this strategy would have worked pretty well, as we spent most of the year above the 10-day moving average and we're rising steadily. So I would have been in the market those times with leverage. So in this kind of sideways to down roller coaster market, my trading really didn't help. In summary, I just put in a lot of work and hassle to basically track the market. So as a positive note, though, I'm obviously pretty happy with the diversified sector ETF portfolio. That portfolio was able to outperform the SPY with similar or lower volatility. So I like its flexibility. I like having those hedges in there. I'm actually bullish on many of the hedges, like commodities in particular. So I'm going to keep trading this 18 ETF portfolio. So stay tuned. I'm going to make a video soon about what I'm doing next. I can't just give up trading. I kind of enjoy it. So anyway, I'll see you in the next video pretty shortly.